Last year's best fund is this year's worst decision. The Recency Bias Trap. Good morning, investors. I want to start today with a quote, not from a market analyst, not from a fund manager, from a Nobel Prize winner. Richard Thaler, winner of the Nobel Prize in Economics in 2017 and one of the founding fathers of behavioral economics, said this. The mistake that investors make is that they look at past returns and extrapolate them into the future. Read that again, because what Thaler described in one sentence is exactly what happened to lakhs of Indian mutual fund investors between 2023 and 2025. And the data tells that story with brutal clarity. The story the data tells. Cast your mind back to the first half of 2024. Small cap funds, mid cap funds, the numbers were extraordinary. Returns of over 30% in less than 6 months. The financial news was full of it. Social media was celebrating it. Friends were talking about it at dinner. And investors responded exactly the way Thaler predicted they would. Small cap fund AUM hit 3.26 lakh crore. Mid cap AUM hit 3.89 lakh crore. And in just the last quarter of 2024, October, November, December, 6,700 crore flooded into mid cap funds alone. The highest single quarter inflow ever recorded for that category. Everyone was buying, everyone was excited, and almost everyone was making their decision based on what had just happened, not on what was likely to happen next. That is recency bias, the tendency to give disproportionate weight to recent events and to assume that whatever just happened will keep happening. What happened next? Small caps corrected, as they always eventually do. Historical data on the small cap 250 index shows a clear pattern. When the index corrects, it typically falls 24 to 25% from its peak, and recovery, getting back to where it was, takes 1 to 1.5 years on average. The investors who rushed in during the peak of the excitement, chasing those 30% returns, following the crowd, doing what felt logical, found themselves sitting on significant losses. And here is what I want you to understand clearly. Nothing went wrong. No fraud, no mismanagement, no black swan event. The market cycle simply turned. As it has always turned, as it will always turn. The only thing that went wrong was the decision-making process that brought those investors in at exactly the wrong moment. Why we fall for it? Recency bias is not stupidity. I want to say that clearly. When a fund has just delivered 30% returns, investing in it feels like the safe, logical, proven choice. The brain says, this is working. This has been validated. Get in before you miss more. What the brain does not say, and this is the part that costs us, is that the time those returns are visible, celebrated, and widely discussed, the easy money has already been made. The investors who benefited most of those 30% returns were already inside the fund long before you saw the headline. Thaler's insight is not just academic. It describes a real, measurable pattern in investor behavior, one that shows up in AMFI data, in fund inflow statistics, in the timing of redemptions, year after year, cycle after cycle. Investors buy what performed well recently and sell what performed poorly recently, doing the exact opposite of what builds wealth. How to protect yourself? First, never select a fund based on its last 1 or 2 years returns alone. 1 year of strong performance tells you almost nothing about what a fund will do next. Second, Always look at performance across a full market cycle, bull and bear, not just the up phase. Ask your distributors specifically, how did this fund perform in 2020 when the markets crashed? How did it perform in 2022 when markets were flat and choppy? A fund that handles downturns with discipline is worth far more than one that shone only when everything was going up. Third, when you feel a strong pull towards a fund because its recent returns were exceptional, treat that feeling as a warning signal, not a green light. The real lesson. There is a disclaimer at the bottom of every mutual fund advertisement in India. You have seen it 1,000 times. Past performance is not indicative of future results. Most people read it as legal fine print. Richard Thaler would tell you it is one of the most important sentences in investing because it is a warning not about the fund but about your own mind. My WealthWise pin-up rule for today. By the time everyone is talking about a fund, the best returns are usually already behind it. Invest ahead of the crowd, not behind it. Tell me honestly in the comments, did you increase your small cap or mid cap allocation in 2024 because of those returns? You are not alone if you did. Recency bias catches even the most experienced investors. Drop your experience below. Let us learn from it together. I am MV Suresh, founder MV Suresh WealthWise. For regular mutual fund updates, connect with me on Facebook, Instagram, LinkedIn, YouTube and Telegram. Wishing you good financial health. I'll be back tomorrow with a new tip. Till then, stay WealthWise.